Ready to get started.
All right, guys.
All right. Share my screen here. All right. Can everyone see my PowerPoint?
Yes, sir. I can.
All right.
All right, guys. So we want to thank you for attending. This is a PowerPoint presentation on the HomeSelect product, which is the most powerful loan that most people have never heard of before. And so we want to welcome you to it. Geneva Financial is our parent company where Jordan and I both work. As you can see, it's well accoladed with a lot of great reviews and wonderful place to be and work, and always the top 10 in various counts. Um, Jordan and I are both certified liability advisors. Jordan, you want to go to the next screen?
Yeah, trying.
Thank
All right.
you. I'll tell you a little bit about the company, a little bit myself, and then I'll let Jordan take over from there. So Geneva is an interesting company. They do everything. So we do the HomeSelect is the most amazing loan. You'll understand why by the end of this presentation. But we do all the traditional stuff: FHA, conventional, VA, non-QM. So we do investment products, bank statement programs. For people who can't qualify due to income, we have DSCR loans, which means if the rent covers all the bills, congratulations, you got down payment, you've got good credit, you're approved. Pretty wild. So it's a non-income loan, non-income proof loan. We do HELOCs. We have $100 million hedge fund in house. So we do bridge loans and fix and flip money in house. We've been closing as little as a week on some of this stuff. Rehab loans. We do construction loans. We have reverse mortgage capabilities. Although the loan you're going to learn about is, I think, better than a reverse mortgage. It has some of the same features if you want them. It's like the Swiss Army knife of loans and much more. A little bit about myself. I got my first license in real estate and finance in 1997 as a realtor here in Las Vegas. I used to manage 400 single family homes with a company that's still in existence here in town. I then moved to Colorado. I became a builder, developer, property manager, certified residential appraiser for a while, and migrated then into finance, where I've been ever since as a mortgage broker, banker, vice president of a company, owner of a net branch operation, and everything in between. And this other handsome guy on the call is my eldest son, Jordan. You want to go and introduce yourself?
Yeah. Hi, everyone. Some of you know me, some of you don't. I'm Jordan Waldman. I've got a applied physics degree and a gerontology master's degree. So kind of get the math, but being a gerontologist, I understand kind of the life stages that we all face.
What is
And
that, Jordan? What is gerontology?
gerontologist is somebody who studies the life cycle of human aging, both from the physiological and psychological standpoint, and from kind of the financial standpoint, the socioeconomics that we all kind of deal with, the multiple stages of getting to retirement and going through life and all the finance side of things that we deal with. I've been in the finance space since 2020, both on the mortgage side of things as well as in, there's some people in the waiting room. Um, so both on the insurance side of things as well as in the mortgage space. And recently got my designation as a certified liability advisor. So it gives me more opportunity to take those math skills as a physicist and utilize them to help people manage their liabilities for their short-term and long-term financial goals. So I'm going to put on my Professor G hat. We're going to do a pop quiz. So I hope you guys studied because don't want to flunk you. Um, show of hands. And if you've been through our presentation before, no cheating. Uh, so give me a thumbs up or thumbs down. True or false? A large down payment will save you more money than a small down payment. What do you guys think? Lauren? Yes? No? Thumbs up? Thumbs down?
I got no thumbs for you. I don't want to spoil it.
What about you, Michael? You're in the finance space. What do you think?
I'm feeling like we got a trick question going on here.
We'll find out. All right, 15-year mortgage. Will that save you more money over time, or is it better to be in a 30-year? What about making an extra principal payment per month or over the course of a year? How about interest rate being the main factor for determining how much you pay on your mortgage? Fortunately, Michael was right. It was a trick question on all of these. In reality, it all depends. And that's where a CLA comes in. We help you analyze these various factors and make sure that your debt, your mortgage is actually working for you and not against you based on the factors of your own financial situation. So today we're mostly going to be comparing the HomeSelect to your standard 30-year mortgage. It's, oops, jumped a slide. So your standard 30-year mortgage, 90% of mortgages are a standard 30-year mortgage. Through most of those, only 40% of homeowners actually get to the point of actually paying off their mortgage. It's traditional. Most people know about it because it's been around since the Great Depression. So your great-grandparents, your grandparents, your parents were all in this mortgage. Chances are you think this is the only game in town and it's the best option for you. That's not necessarily the case, but it's what people know, so they're comfortable with it. All right, I'm
Bless
meeting
you.
another person. So yeah, I mean, a traditional mortgage, it's highly inflexible. If you pay extra into it, it's paying down your equity and it may reduce your term, but you still have to make next month's payment. There's no flexibility to skip a payment if anything happens. And your equity is illiquid. You can't access it unless you're selling your house or you're going through another refinance. So it's costly. And so that leaves us with an opportunity to save a significant amount of interest over the time because your mortgage is front loaded on interest payments and it's over 30 years, so you're paying a substantial amount of time. And there are better vehicles that can utilize free cash flow and use it to reduce the cost of borrowing, pay off your mortgage more quickly. You get access to the equity as you're paying it off, and you get complete control of when and how you repay your mortgage. So it's much more flexible than your standard 30-year. And so for the HomeSelect, we put people through a simulator so they can compare side by side with a variety of other products from the 30-year, 15-year, ARMs, interest only. But you can see and weigh out whether of those options are actually beneficial for you. And that's where our skill sets as a CLA, Certified Liability Advisor, are uniquely educated to guide homeowners through this decision process, find ways to free up cash flow, save on interest expense, and build wealth over time. So like I said, we start with a simulator, and based on your home value, loan amount, monthly cash flow, and what is left over at the end of your month, we calculate whether or not this loan is a right fit for you. It gives you a glimpse into how much you can save, what your effective APR is, how quickly you can pay off your home, and how much you can invest once you have your mortgage paid off. Now, looking at a 30-year mortgage, there's some downsides, but with any loan product, there's pros and cons. Your 30-year mortgage, it's slow. It takes decades to pay off. It's inefficient because it's interest front loaded. It's very rigid, and it's expensive. Typically, your loan costs anywhere from $150 to $180 in interest per $100 borrowed, unless it's an exceptionally low rate, and that is rarely seen unless we're in the midst of a global crisis or pandemic. But it's good for first-time home buyers, those with low positive cash flow, passive income earners. So there are some pros and cons, but say, for instance, like we experienced, a lot of people were laid off for various economic reasons during the pandemic. Luckily, banks allowed some people to defer payments, but if you get laid off from your job regularly, that's tough. Your bank doesn't care. They demand that you make the payment or you lose your house. So you've got to make your payments, and so it's just this weight hanging around your neck that you've just got to handle regardless of your circumstances, whether you are ill, whether you had a major life experience go on, it doesn't matter. You have to make your payment. But with your 30-year mortgage, it's like being in a horse-drawn carriage versus your modern car. One will get you there faster, safer, and more comfortably. One will do the same, but there are better options out there. So when we look at the way a 30-year mortgage is structured, you're paying interest first over principal. I remember when my wife and I bought our first home 7 years ago. I'm a physicist. I get the math. I get that you're paying interest because you're borrowing this money. But man, it is disappointing to go month after month and just see your principal just tick down just such a little amount. I mean, most people don't realize that it takes 222 months, so nearly 18 years in, before that flip occurs and you start paying off more principal than interest.
60%. You're through 60% of your mortgage before you even start paying equal amounts of principal.
And banks love this because you're paying all this cost to borrow this money up front, and they know you're going to refinance every 3 to 5 years. If you're financing an $825,000 home, or purchasing an $825,000 home, finance $680,000 of it at a typical 30-year mortgage. The amount in interest expense at today's rates, you're paying nearly $1 million just in interest expense, let alone also the principal that you borrowed. So the total expense is nearly $1.7 million. And yeah, after your 30 years, your house is going to appreciate. In this instance, their home would appreciate nearly to $2.67 million. But they paid $1.7 million to get there. So why pay this much if you don't have to? And this is assuming that they never refinance. Most people, they refinance multiple times. And don't get me wrong, there's plenty of reasons to refinance, but it has to be carefully weighed out with other risks. When you refinance, you're restarting that 30-year clock. If you take out more money, you're now upping the amount that you're repaying back. And if you're not balancing this right, it's eating through your cash flow and eroding that foundation of wealth. And on top of that, you're borrowing for cars. You're borrowing, if you struggling with your cash flow because your mortgage is eating up most of that, well, how are you going to help your kids pay for college? Well, now they're taking out student loans and it's affecting their ability. And you've just taken a legacy of wealth building and wiped it out. So a CLA comes in, we help you manage those liabilities, make sure they're working for you, not against you. And like in this unfortunate example, it's stifling their cash flow, and there's a better vehicle. So we're going to show you the most disruptive loan on the market, one that allows you to pay principal first, grants you access to your equity 24/7 without need to refinance. It offers you flexible payments so you can skip payments without penalties or hurting your credit. And it allows you to pay off your loan in a fraction of the time and saves you hundreds of thousands, if not more, in interest expense while doing so. I'll let Doug take it from here.
Jordan, you might have Adam in the waiting room. He just logged in looking for the Zoom link.
All right, thanks for letting me on.
Yep, I sent him the link, but I just want to let you know. All right, guys. So the HomeSelect, I've been in the game since 1997. I had never seen this product until last year, when we became one of the only correspondent banks in the country with it. And it was, a lot of the feedback we get a lot of times is, well, it's too good to be true, or it's new. It's actually not. It's been around since 2005. Richard Branson, Sir Richard Branson, he and I are on a first name basis, of course. Sir Richard Branson of Virgin Records, Virgin Atlantic, Virgin Airlines, Virgin Cruises, brought this product here, the billionaire from Australia. He brought the product here in 2005. CMG became the bank that put this loan together. So it's been around for quite a while. We have the details on it. There's no other mortgage I've seen that lowers the cost of home ownership and shelters the client from interest expense while building safety, liquidity, and return on unused income. If you've ever heard the term offset mortgage, this is analogous to an offset mortgage. It puts working money to work. I pulled up a quote earlier today from Einstein. Compounding interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. This takes advantage of that. And so how does it do it? It is a 30-year first position home equity line of credit tied to an FDIC insured checking account. And it's a very special checking account. It uses what's called zero balance sweep technology. And what that means is the two vehicles are tied together, and the funds that you deposit normally into your checking account are, instead of just sitting in a checking account where the average borrower is very gracious to their bank, they lend the bank money at less than 1% return and let it just sit there. This stops all that, and it puts the money to work for you, sheltering you from interest expense. The money's always available. It's just not sitting unused. We're utilizing it to protect the borrower from interest expense. So I'm going to walk you through a couple of scenarios of a couple of clients that I've closed recently in this product. The first one moved recently from Chicago to California. He and his wife make pretty solid money. The annual income net was around $385,000 a year. Their expenses roughly ran 70% of that. They kept 30% of that. Now, they bought a $1.15 million home in Southern California, a starter in Southern California. And they borrowed about $920,000 for the primary residence. So the loan, when we moved them over, was a 7.6% rate. They were in it about 6 months. We actually had to wait for them to make their sixth payment to move them into this product. They didn't qualify for it at the time because they had two houses they were financing. When we moved them into this, the rate, and I want you guys to remember this, the starter rate on this loan for them at the time was 9.3% on a variable rate. This is to teach you that interest rate is not the end all be all if you understand how money flows and how compounding interest works and compounding loans. Okay, so they borrowed again $920,000 at 9.3 on this HomeSelect. Jordan, if you can move to the result, and we're going to give you guys access to the simulator. The top left corner in the green, in the yellow, there is the result page from the simulator, and you guys will all have access to the simulator. You'll be able to put in your own scenarios and go play with it and see how it works. But that client ended up getting to the position where they can pay off that loan in 5.8 years. At the end of that, now keep in mind, when they bought this house, it was 1.15 mil. In Southern California, going up at roughly 4.5% per year in the market they were in. By the time 6 years rolls around, 5.8 years rolls around, that's going to probably be a $1.5 million house, free and clear. They'll have a $920,000 line of credit, free and clear. And the really crazy number is that bottom left number. That is how much they're saving over a 30-year amortizing loan. Even though I spotted them 1.6% on the rate, they saved $1.25 million in interest expense. And what's even crazier is the bottom blue number. Their comparison loan effective APR was 1.3% on this loan. So when people tell me, well, this other guy quoted me 6, I'm like, I'm going to get you under 2, right? It just doesn't matter what the rate is. It's the velocity at which you retire the debt is much more important. Somebody borrowing, $920,000 for 30 years at 7% is paying $1.25 million more than somebody who borrowed the same amount of money for 5.8 years at 9.8%. But trying to compare apples to apples, we have an algorithm that turns, because obviously a amortizing loan has an APR, a simple mortgage or simple interest loan does not, because it's simple interest. As you pay it down, if you're making the same payment, the payment's more powerful because you have less interest charge. Much, much more better. It's just a better mousetrap is the best way I do to explain it. Now, one thing that's really interesting about the simulator is, now this is a young guy and gal that bought this house. They're in their 30s. The guy's a sales rep, makes solid money, so does his wife. Now, they had already signed on to paying $6,500. You can see on the top on the right there, $6,500 in principal and interest expense on the loan. By taking that money and getting the loan paid off quickly, and then taking that same $6,500 and investing it into a wealth building vehicle, let's say at 7%, which most financial planners will tell you that's a conservative number. So if they got in at 7% and parked it there for the duration of the loan, so for another 24.2 years, and we assume that the appreciation on the house is standard at 3.5%, you could look at the difference in the net worth of just investing in an amortizing loan on the bottom at 3.2 million versus our model where they have a net worth almost $5 million higher. That is the power of this loan. And you can see in the amortization in the green that at month 70, they own the house free and clear. And on a 30-year mortgage, they're still at $861,000 in balance. It's that powerful. Jordan,
with the standard mortgage, you can't access that 58,000 without refinancing.
And right. And the big thing is that you are liquid for all that money. So if you pay down halfway, and let's say after month 30, they have $450,000 available on that line and $450,000 balance, they can literally stop making payments on that loan like a reverse mortgage, and the balance just climbs. They can write a check against that $450,000 available on the line and buy an investment property, fund their kids' college, retire their parents, put their mother in a senior center, whatever it is. That's the power of this loan. Another example, these folks moved from California to Henderson, actually, Michael. They're neighbors of yours. Nice couple, both professionals, no kids, $195,000 net. Spent about 65% of that. And again, obviously, if they're W-2 employees, their net is after, that's post insurance deductions, health insurance deductions, and after their 401k deduction and their taxes, right? They're still saved 35% of their net income. The house was $745,000. They owed $550,000. They had a 7.25% rate that we were comparing it to. Our rate at the time, and it's dropped since then. In fact, I called them recently and said, hey, your loan is now at 7.8. Congrats. They said, great. We think we figured out how to get this thing paid off in 3 years and go buy a house in Hawaii. It becomes a game. It's really interesting. Clients start trying to figure out how fast they can retire this debt and then get into other wealth building vehicles, which is why financial planners, insurance agents, realtors love this loan, because the clients come back and do more business with them. So it's a very interesting product. Jordan, next slide. And again, this client, they're going to pay off the house in 6.2 years. That house will be worth probably about $1 million in 6 years. They'll have a $550,000 line of credit, free and clear. They only made 74 payments, and I'm saving them 2/3 of $1 million. Do you think I'm on their Christmas card list? I am on their Christmas card list. Their effective APR, comparison effective loan APR, was just shy of 2%. And again, same scenario. If you look at the top right, their $3,700 payment, $3,800 payment, if they reallocate those funds after they've retired this debt, which are now completely liquid, but if they just reallocate that debt or that payment for the principal and interest, they're more than doubling their net worth at the end of 30 years. And again, you can see how fast the equity builds up. 73 months, they've retired the debt, basically 74 months, versus on a 30-year amortizing loan, they still owe $510,000. There's nothing like this. It's just the best first position lien available in the United States. Hands down. Next slide. Final scenario. This guy is a heavy equipment mechanic. Union guy in California. House was $790,000. We got him into his first loan with an FHA loan. And roughly 2 years later, he came back. He said, hey, Doug, I heard about this loan. What do you know about it? I said, we just rolled it out, actually. It's funny that you heard about it. Again, $136,000 net, $81,000 in expenses. He retained $5,500 or $55,000 in a checking account that he was aggregating funds in. We changed that structure. He was at the time, we were comparing it to a 7 1/8 fixed mortgage. Our loan at the time was 9.2, and the results are absolutely astounding. He's going to pay off that loan in 8.5 years. We're saving him $708,000 in interest expense. His comparison loan and effective APR was 2.25. And again, you look at the top right, he's doubling his net worth by utilizing this tool. And that investment could very well be insurance, real estate, stock, right? All these things build wealth. It's just assuming a 7% growth. That's what his net worth looks like 30 years later. And again, same kind of thing. 102 months, he's paid off his house free and clear, versus he still owed $600,000 with a 30-year amortizing loan. See? So again, if you look at the blue is the trajectory of how this loan pays off. The average client pays off in 7 to 12 years. And you'll notice that the balance drops, and then all of a sudden there's a life event. The three big events in most people's lives when it comes to finance are buying a home, getting the kids through college, retirement. And this allows you to do all of that without having to refinance each and every time and resetting that 30-year amortizing clock, where you go right back into the sweet spot of the profits for the bank. In fact, the only time people refinance this loan, it's a 10-year full draw line of credit. After year 10, it starts to dwindle at 1/240th a month until you get to zero at 30 years. Clients have figured out that they can, if rates get to the bottom, for example, because we know rates are cyclical, they get to the bottom, they might lock in for a 5-year term, like an adjustable rate, 30-year arm or a 5-year arm. But the other reason is because they want a bigger line, and they figured out that, okay, if I bought this house and it was worth $1 million and my line right now is 800,000, I might owe 500 on it. But now my house is worth 1.5. I can now take my line to 1.2 million, even though I still only owe 500,000. And now I've got that much more safety net, which is their holy shit fund, their emergency fund, as I call it. So you can see that as life events happen, the balance will climb up, and then it dwindles back down. Jordan, next. So, Jordan showed you the comparison of the typical borrower on a 30-year amortizing loan, and you'll see that the people start aggregating debt, and it starts climbing, and payments grow because the 30-year does not adjust to the balance. While if you look at the right, it's our loan, is the balance never really goes beyond what was originally borrowed, but you can roll that debt inside the vehicle itself, thereby sheltering yourself interest expense and sheltering yourself from climbing expense. So you can literally go, you're ready for a new car. You can walk into the dealership and negotiate a cash price and write a car, finance it yourself. You never have to go and reapply, because as Jordan mentioned, and one of the biggest, scariest things I can think of is when people have not reached out to a Rachel or to a Shakara or to a Roe to get insurance that covers them in the event of a cataclysmic event, like a firing, like a layoff. They're in trouble because they no longer qualify for a mortgage. So first of all, everyone should have a HELOC, regardless of whether it's a HomeSelect or just a standard HELOC. Everyone should have a line of credit attached to their house. It protects their equity. It also makes them impervious to cataclysmic events because it gives them purchasing power or time, right? It gives them liquidity to get through such events. Because if most people, and we know that there's a shortage of savings, there's an abundance of equity, and you can't eat equity. You need something attached to the equity to make it liquid.
Also, a lot of people have locked in to a nice rate, built up this equity, but then they've maxed out credit card.
Right.
Can't remember what 30% of people have at least one maxed out credit card.
Right. Consumer debt is another catastrophic event waiting to implode. Right. So we have an abundance of equity. And again, people get caught up into these velvet handcuffs of, well, I've got a 3% rate. I've got a COVID rate. I'm showing you how you can get a rate in the 1s and 2s. I don't care about a 3. And when you take a blended rate of a bunch of consumer debt at 25%, and then you've got your 3% rate, your 3% rate is not really the 3% rate anymore, right? The blended rate is probably in the 4s and 5s, determined by how much debt they have and what those other interest rates are. Next slide. So this just simply shows the mechanics of it. So in the burgundy, you have the available equity on your line. The yellow is your deposit each month. Let's say it's a static deposit, your W-2, and each month. And then the blue diagonal line is your expenditure, and the blue vertical lines are your expenditures. And you'll notice that each month you're building up a little bit more equity, and so you're paying down principal and building equity, and that allows for utilization. And what this loan does is each month it aggregates the amount of interest you've used for the month, and on the 21st of the next month, you simply owe an interest-only payment because you're always paying principal. Imagine this. You have a $100,000 line of credit. You make a deposit. You've already paid your bills for the month. On the first of the month, you deposit $10,000 into your account. At midnight, the zero balance sweep technology, you don't have to do anything. It does it automatically behind the scenes. It moves the money from the checking side to the line side and pushes downward by $10,000. It calculates the interest right after that. So you now really only owe $90,000 and are charged $90,000 on that debt, or you're charged interest on the $90,000, not on the 100. Does that make sense? Blink if you can hear me. All right. Now the next, let's say 5 days later, you had a car payment due for $1,000. You simply write a check out of the account, and all that happens is your balance goes from 90,000 to 91. For the first 5 days of the month, you shelter yourself from being charged interest on that $10,000. So in one model, you have your 10 grand sitting in the checking account earning you nothing. Or in this model, for 5 days, you shelter yourself from being charged 7% interest on your mortgage on that 10 grand. Then extrapolate that over and over and over, day in and day out. That's the power of this loan. And part of the reason it works is because, well, Justin, we'll get to that at the end. Are you talking about impounds for your taxes and insurances? Yeah, absolutely. If you want, yep. But if you look at the way people handle their bills, they aggregate their funds in these horrible checking accounts and savings accounts that pay nothing. So they're giving money to the bank. The banks then rent that money out to other people at profits, and you're not participating. You are literally giving away money to the bank. You got to really love your bank if you're doing that, because here's how people's finances work. You've got your weekly bills, your food, your entertainment, dining, right? Your fuel, gas for the car. In our house, Amazon has become a weekly sport. Then you got the monthly stuff. You've got the home utilities, cell phones, cable, credit cards, your mortgage, your car payment, your quarterly, your insurance, medical. You're aggregating some holiday expenses, right? Your semi-annual, you got your property taxes every 6 months, maybe some travel expenses if you're traveling twice a year, and then you've got your income taxes. All that money sits around doing nothing, and instead of lending it to your bank, you're basically lending it back to yourself, sheltering yourself from interest expense. Brilliant. It's just a better mousetrap. Gee, there we go. Thank you. So the terms are pretty simple. You need a 700 FICO score, 720 for investment properties. You can go to 90% with a one-time upfront MI payment, mortgage insurance payment, which is awesome. You're not like in conventional loans, you're paying upfront, or you're paying consistent mortgage mortgage insurance payments until you have at least 20% equity. We do one payment up front. You can pay it in the form of a concession from a seller if you're buying, and you have no mortgage insurance on this loan, which is great because the interest expense is all deductible. Mortgage insurance is not. So you can knock that out. And if you can get it as a concession, it doesn't affect you at all. We can go to 90% on purchase and for primary residences, purchase and refi, 75% on investment properties. We can go to 80% cash out on owner occupied. we need a 43% debt to income ratio, which is the amount of your monthly expenses divided by your monthly gross income. That gives you your debt to income ratio. We need a reserve. We don't touch it. We don't need it for the loan. We never access it. We just need to know you have access to some reserves, typically in the amount of 15 to 10%, depending on your debt to income ratio. That can be anything: stock, gold, bonds, crypto, I believe. And then the real secret sauce is a client that has more money than month. Somebody who's living hand to mouth, a 30-year amortizing loan where there's no variability and they can just schedule their minimum monthly payment every month is probably more apropos. But for people who understand how finance works and how to manage their funds, this is just a much better loan. It's tied to the CMT index, which is a very stable index. We're usually about 1% over what conventional loans are. The last couple of years have been just weird for the mortgage market in general. It's been detached from anything that would resemble normalcy. We'll see what happens over the next couple of years. And basically, there's no balloon payments. There's no prepayment penalties. Like I said, it's a 30-year draw. We can go up to $3 million without any sort of geographic limits, and we can go to $4 million on exception. At over $2 million, you need more down payment or more equity, typically about 30%. But it can be used for purchases, refinances, non-owner occupied property, secondary homes, primary homes. Yes, absolutely. And we'll go through all these questions here in a minute. I'll pull up all the questions and answer them. But yes, the powerful thing about this loan is I had clients that, this first slide, you saw that we're at 9.2, 9.3. They're now at 8. And they did nothing. They just had their loan, lived their lives, and their rate has dropped by a point in the last 3 months. Again, I am definitely on their Christmas list, right? Because all those examples that I showed you we just assumed that the rate stayed the same. We actually didn't do any of the analysis based on the rate slowly dropping back to historical norms, which is 6% on this loan. So these clients are going to do much better than what those scenarios even showed, simply because the rates have already come down from what we did the calculation on. So basically, like I said, it's a first position HELOC tied to an FDIC insured checking account issued by a nationally federally chartered bank. It has all the same bells and whistles of any other major checking account, ATM card. You can write checks, you can wire funds, you can get access. They have the account security. It's FDIC insured, and then it's got this neat technology, this zero balance sweep technology, which I actually believe there's some insurance products that utilize that too. Your insurance folks could probably confirm that down the road for us. But I believe I've heard that there's some other sort of products that do utilize zero balance technology as well. Good, G? And that's really it in a nutshell. If you go to the website, HomeSelectChallenge.com, or behind me, you can see GoHomeSelect.com. It'll take you to the same place. And that website is loaded with more examples and actually how we put information into the simulator. You have access to the simulator from that website as well, so you can go in and play with scenarios. The second page of that website also has how to, because we know in anything tech, garbage in, garbage out. And if somebody puts in bad data, they're going to get a bad result. So we're going to teach you how to not do that. But people love to go in there and play with it. And like I said, those clients of mine that said, Doug, we think we can get done in 3 years. That's what they were doing. They were moving money around between investments and their 401k and figuring out that if they stopped putting money into a 401k where their employer was no longer matching, like they were putting above whatever their employer was matching, and reallocated those funds, they can get this loan paid off much, much faster. So you have access to all that. There's frequently asked questions in there as well. I know there's some questions on here. Let's see here. Can you set up impounds? Justin, absolutely. And yes, and the rates drop or rise. But as you've seen, we can spot the market 2 points and still kick the living shit out of a 30-year amortized loan. Because, again, the reason everyone is convinced that they have to beat the loan officer up about rate is because that's really the only thing people can control if they think the 30-year amortizing loan is the only loan available. Because there's only three pillars that make up what a loan costs: how much you're borrowing, how long you're going to have the money, and what the rate is, right? And since let's say in an example, let's say Brenda needed $600,000. Well, if she thinks that a 30-year amortizing loan is the only loan, then those two levers are already pulled. The only one left she has to play with is rate. That's why everyone's so crazy about rate, right? But the biggest lever to pull is actually how long you have the money. If you can figure out a way to pay down this debt faster, still be liquid, so you're still not losing anything. You're just reallocating funds from sitting in your checking account, aggregating dust and lending it to your bank for free. You can actually lend it back to yourself, save yourself 7%, get your loan retired in 5, 6, 7, 8 years, and rate is really immaterial in that scenario.
So, quick question: in your scenario, you're basically showing the adjusted gross income of whatever is left over that would be deposited into a checking account, and really that's just a straight principal payment to the balance.
Right.
The mortgage is being recast on that new balance, and then living expenses you can write against that, basically the line, which the line would transfer the funds back over to the checking account and clear that check that was paid.
Exactly.
Okay.
Nightly. And it all happens behind the scenes. The client does nothing different than what they already do.
I think the only difference is the psychological aspect of the feel good of, I got, 50,000 in my bank account or 10,000 in my checking account or whatever, and I get to see it.
And there is something to that. However, a credit is a credit, right? Nobody has paper in the bank. We've got ones and zeros.
Right.
So having a credit in your checking account or having a credit on your line, the same thing. It's still the same money, right? So it's interesting you brought that up, Justin, because when I saw this loan, I'm one of the first people in our company that flipped out about this thing, changed the entire trajectory of my career, built websites, got educated, became a certified liability advisor, which is it's a course taught by a guy who's a University of North Carolina professor who trained Merrill Lynch, Ameriprise, and AIG had to do $3 billion of this loan in a 2-year period. And the interesting thing is that once you get past that psychological component and they realize that they don't have to do anything different than they've already done, it's really immaterial. It's just a different way of thinking. When I saw this, I emailed the owner of the company and of our company. I texted him actually and said, "Aaron, why are we not going stupid with this loan? This is the craziest loan I've ever seen." He says, "We need loan officers that can understand it enough to decondition people who've been brainwashed into 30-year amortizing loans being the only thing in town, and then re-educate them on a better vehicle."
Yeah, that makes sense.
And that's what Jordan and I are doing.
This doesn't preclude you from having an outside savings account if you wanted to save, 3 months worth of expenses as a just in case fund.
Sure. What bank is it tied to for the checking account?
It's a bank in Indiana. I can't recall off the top of my head. I can find out for you. But it's a federally chartered, FDIC insured bank, depository bank.
Got it.
And for the insurance agents on here who are trying to get, helping people reach their target premiums, they can still use this to shelter the expense while it's in their account and then fund their IUL in that month. So they're double dipping where they're saving on interest expense plus growing their retirement savings. So it's a powerful way to do both at the same time while they're paying off their mortgage.
People get really good at this. People, again, turn this into a sport and realize that, okay, I'm going to put all my life for the month on a points credit card of whatever travel or rewards points they want. They pay everything for the month on a card. They put all their money into the account to shelter themselves from interest expense, because now if they're depositing $10,000 a month, their whole 30-month period has now been sheltered from any interest expense on that $10,000 deposit. And then the last day of the month, they pay off the credit card from the line. But that way they've yielded an entire month of sheltering their deposits in the form of savings and interest expense.
So you're saying that they would basically charge everything against their credit card. Their adjusted gross income, W-2 paycheck, would be paying into the checking account, which would go down, pay the principal balance. At the end of the month, write a check to pay off the credit card.
Yep.
And then just
but for that entire month, if let's say they deposit 10 grand, so all month they've now had 10,000 lower balance that they were not charged interest on.
Well, I mean, yeah, I understand that point, but there's still going to be interest expense against the mortgage on the HELOC
For the other part, but not the 10 grand. So if they borrowed 100 at the end of the month, if they have 100 balance, if they deposit 10 grand on the first, all month their balance is only 90,000.
Sure.
Then they have the interest expense of whatever the rate is times the 90 grand all month, but not 100.
I get that.
And again, if you duplicate that month in, month out, there's aggregated savings, right? And then the credit cards aren't charging you interest as long as you pay before the next cycle. You
just have to charge. You can't charge a credit card above what would be the difference of the interest expense against the mortgage. You see what I'm saying? You can't deposit, say if your paycheck is 10 grand a month, you can't charge 10 grand because if you only have 10,000, there's still interest against the interest, against the mortgage.
Of course, right.
So say it's
now
$500
you're dipping into the line side and you're actually growing the balance.
Okay, I got you.
Right. But the other interesting thing to me is, again, the fact that once you have a holy shit event, you're already screwed.
Oh, yeah.
Right. And this loan stops that. In a regular HELOC, just a second position HELOC will do the same thing. But this ties that all together because the minute the barn doors open, it's already too late. Hey, I'm sick. We're all, I think a lot of us are either financial types or investors on this call. We hear all this time that, oh, Doug, I do that. I make a half a payment every 2 weeks. And we're like, yeah, that's 13 payments a month. You'll pay down your loan in 22 years. Do it twice, and now you're doing it in 17 years. Great. Do that for 5 years, and then call your lender and say, hey, I just got laid off. But I've been really good. And you know what Lauren's going to say in customer service when I call her up and tell her that? She'll say, that's unfortunate. Make your damn payment.
Right. Yeah.
This, you don't have to ask anyone for anything. You become your own bank.
Cool.
Other questions?
Is it possible to go back to the slide you had where it was showing like the equity going down over the 30 years?
Yep, one moment. Let me pull it back up.
You talking about the blue one?
Yeah, I was just curious there. At the end of the 30 years, is your home equity going somewhere, or you still
No, your equity stays there. Your line starts reducing. Because again, they don't want to lend this into infinity. At some point, they need to say we're done. So it's
gotcha. So the equity is not the house value; it's the line of credit value going down.
Yeah,
exactly.
Okay.
And again,
the equity would be climbing.
Right. Equity would be climbing. That's why people will often refinance, even if they have a very small balance left. They're willing to pay the fees because you're only going to pay on the amount you borrow, not on the line. Right. So Let's say after 10 years, I didn't quite retire as quickly as I want. I still owe 300 grand, but my house is now worth 1.5 million. We can go to 80% of 1.5, $1.2 million line of credit. They're only going to pay closing costs and fees on the 300 grand they owe. And now they've got a $900,000 holy shit fund.
I think I just got confused because it says available equity dollars. So I was like, whoa, wait a minute. Is this like a reverse or okay, it's just the line going down.
Well, again, keep in mind, this is not equity. And that verbiage is weird. I will grant you that, Michael. Equity on the line, not equity on the property. Right. Because you still have appreciation climbing, right, as well. And then this is just, but you can't control, and you're a victim of appreciation. You have no control over that. It could go up, it could go down, markets can crash, there could be a bubble, but you can control your line, the balance on your line. That equity you can control. that make sense?
Looking good. I like it.
And again, it's not going to be for everybody. Some people will not see it. I've got a friend who's been a wholesale rep for 20 years. And he and I bumped heads for 3 weeks. I was trying to explain this to him. He could not get his head around where's the money in the checking account go? How much interest am I getting on my checking account? For 3 weeks. And this is a guy that's been a mortgage rep for a very long time. Could not get his head around it. Other people see it right away and click. Michael, I can tell you see it. Justin, I know, gets it. Rachel, what do you think? You seeing it? See how it works? You have some questions?
No, I don't have questions. I took some notes. It's pretty easy to understand.
It really is, right?
Mhm.
And I'm blown away when some people are just like, yeah, I don't get it. I want a conventional loan. You just told me you want to pay another $1 million for the exact same amount of money you just borrowed. That's what you just told me you want to do if you want to stay in a 30-year amortizing loan and you qualify for this. That I can't get my head around. Anyone else? Brenda?
What are the because I know generally with the HELOCs that I've done in the past, they're the costs associated are pretty limited. So what are the costs for? Is it just
Say it
for
again, I'm sorry?
whatever the principal balance is?
What is the cost on the loan on actually doing the loan?
Yeah.
It's going to be about the same as any other 30-year amortizing loan. There's going to be a point or two probably, and traditional closing costs.
All right, you already lost me at a point or two.
Honestly, I didn't lose you, Justin, because again, if I'm saving you $1 million, you're not gonna really bust my chops about an extra 5 or 10 grand.
To put in perspective, those closing
Money's money.
costs, most people have recouped that in 6 to 12 months of being in this loan.
If that.
Sure.
A lot of people do it in the first 3 months.
So on the simulator, I can go in and play around and put in some scenarios.
Knock your socks off, man. That's you financial types love that thing.
Okay, cool. Is there a limit as to how many properties I can do this with?
You can do it with
Because it's
3.
only predicated based on a checking account and W-2 income. So
Well, it's not really, it doesn't have to be W-2 income. It can be just any money going into your financial ecosystem. So if you've got 10 properties, but put 1 property in this loan, there's nothing precluding you from doing that. It doesn't have to be W-2 income.
oh, okay.
I was just showing you that these particular borrowers were all W-2 employees. We have a lot of self-employeds that love this thing because they work it out with their accountant where they take all their money from their whether it's an LLC or whatever, float it through the system and then back into the LLC. And as long as they account that properly, they're able to shelter themselves from all that interest expense. People who are doing they're utilizing Schedule C, where all their money's in their personal account anyways. It's their money. So people who are self-employed who have to aggregate the tax consequences or tax liability, they really benefit because they park a lot more money in their checking account anyways. Because they have to pay, they don't have an employer that's pulling out taxes and matching it. They're on the hook for all of it.
And you still get the mortgage interest deduction, right?
Yep. It's a mortgage.
Yep. Cool.
So again, to answer your question, you can have one in each of the 3 categories: owner occupied, second home, non-owner occ. But you end up diffusing a lot of the power by spreading it between 3 properties anyways. So even though you can do it, most people typically pick the one they want paid off first, which is their primary for most people, unless you're trying to really knock out some investment property because of cash flow reasons or something else. And they pick their primary and that they knock it out.
People that use this for the investment properties like to use it as an interest-only loan because it offers that flexibility, but they still have access to the equity to do repairs or regular maintenance because you're dealing with wear and tear. So
Yeah, and I guess my question was on the impound account. So can you still establish with the HELOC and the mortgage company, the servicer, to where impounds are taken care of?
Taxes and insurances. Yep. Absolutely.
Okay.
Yes, sir.
Anyone
Anyone
else?
else?
Any questions?
Were you guys licensed across the U.S., only certain states?
Geneva's licensed everywhere but New York. Jordan and I right now have 6 or 7 licenses. I can get licensed in any state in 24 hours to 48 hours. So not a problem. I just picked up Texas recently. In fact, I just finished my continuing ed for Texas today. I had a loan in Nebraska, of all places, the other day that I knocked out a loan for a gentleman in Nebraska, got temporary authority there. Cost me a couple $100, and 24 hours I had the license. Most states are pretty easy. If you'd like to start doing Hawaii, let me know. I'm definitely down for that, and I will go there and personally deal with any clients you might have there.
How about commercial properties?
We have not for this product. You can do up to 4plex on this product.
So this is still Fannie Freddie underwritten.
I'm sorry.
Still Fannie Freddie underwritten.
Correct.
Okay.
But we have access to a lot of big. I was a vice president at Draper and Kramer, and I have a co-vice president there that has a $3 billion a year commercial lending operation. So any clients that are looking for commercial money, I put them directly in touch with him, and they're dealing directly with the president of a $3 billion company. He handles with kid gloves all my.
But is it the same product?
No. This product will go only up to, like I said, up to a 4plex.
Okay, gotcha. Thank you.
Yep.
And I'm assuming this is obviously still trade compliant. Are you guys are a broker then?
We're bankers. This is our money. We're a correspondent banker with this product. All products that we have. The only thing I think we broker out are probably second position HELOCs. Everything else we use our funds for, including fix and flip money. We have an in-house hedge fund, so we can do fix and flips. We can do bridge loans if the client is equity heavy in departing property A, buying property B. We'll tie up property A on a lien, buy them the house B for cash. They then liquidate house A, pay off the loan, or if they don't have enough, we refinance out of the balance. We can do that stuff. Fix and flip, like I said. We do it all in-house.
You paying for referrals?
That would be illegal, sir.
I figured. Thank you, Trade.
But you send us business, I'll make you a marketing director, and I can put you on a salary. That's legal.
Sounds good.
Yeah, we have realtors that are able to do that. We can't. It's illegal. It's a RESPA violation to pay per deal on percentage or otherwise. I mean, our lobby after 2008, 2009, 2010, our lobby was so horrendous that if we give I think anything over a Starbucks card, we are literally screwing with our licenses.
I completely understand.
Yeah. So we've learned that, but I can't, if somebody is consistently sending me business, I can put them on a salary, not based on the referrals, but based on the fact that they are consistently sending us business. And that's the same as any other marketing director or something like that. That is compliant to my knowledge and understanding.
Sounds good. You're here in Vegas?
I'm here in Vegas. You want to meet up? Grab some coffee?
Actually, I got a networking meeting on the west side of town tomorrow at Panera at 10 o'clock if you're in.
Done.
I'll send you the info.
Right.
Any other questions before we wrap up for the evening?
All right, y'all. We appreciate you being here.
Thanks for coming. If you have any further questions, you can always reach us at,
Well, my number's behind my head right here.
Yeah.
805-231-1644.
or my number, 805-368-3477. And probably interacted with us via email once or twice at this point. Well, talk to you guys soon. Have a good one.